Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show.
Hey everybody, welcome back to the DIY Wealth Canada pod. I'm Nelson, I'm here with Bob, and today we are going to talk bubbles, not those fun things that you made with your kids, but financial bubbles that have the potential to seriously harm your portfolio. We're going to specifically talk about what I think Bob and I agree. We haven't really talked about it yet, but we think there's an AI bubble happening, and we're a little bit worried about that. So we wanted to talk about that, but then also bubbles as well to hopefully help you guys identify what's a bubble and maybe take a little bit of the other side too, where maybe bubbles aren't so bad, assuming you do some things right. Bob, are you ready for this week's episode? Are we going to burst the bubble by talking about it? Like maybe, right?
Well, maybe not. Yeah, I'm excited. I think it would be good to argue from both sides to see it's not necessarily just like it's going to happen, right? So let's see where we go from there.
So I think the thing that really, I know we were talking about this a little bit beforehand, the thing that sort of inspired this week's episode was the Allbirds thing that we recorded these in advance. This is going to be a few weeks old for the people listening. But Bob, tell me exactly what happened with this Allbirds scenario, because I'm still wrapping my head around just how stupid this was.
Yeah, me too a little bit. It was an article that I came across and shared with Nelson. I think Allbirds is a shoe company, or used to be. So they were making these shoes, and then the business didn't really go anywhere. And recently they sold all the shoe portion to another company, and then they turned into an AI company. I think they're now all about AI, like data center and stuff. It's basically doing a complete 180 turn pivot to AI instead of focusing in your sector. So that's similar to if TD or any of the Canadian banks were just to pivot, basically sell their banking portion, investment portion, pivot to AI data center. So it was a pretty big shift. Now the crazy thing is, because this shift, the stock went up, I don't know, like 300-500% or something crazy. So yeah, that was just mind-boggling a little bit.
Yeah, my first question is, what does a shoe company know about AI? Like, why? Okay, maybe I'm a little bit like skeptical or whatever, but the first thing I would say to myself is, hey, why would if I wanted to invest in AI, why would I do so using a shoe company rather than one of the tech giants, whether it's Microsoft, Google, even Amazon? Like, I know all of these guys have their own AI and they're all building data centers as well. So that's kind of like my first question is, why would investors be so dumb to chase something like this? Of course, we all know the answer. It's that it's a speculation and it's a way to get in on something on the ground floor and get rich in a hurry. I'm looking at the chart. The stock was, before all this happened, it was a $2.50 stock, and it rose as high as kind of 17, 18 bucks. Now it's down to 11 as we record this. Just silly. I don't know. Bob, would you ever play something like this in terms of, I'm going to throw $500 at it and see what happens? Or are you like me where I say, no, capital's precious, I couldn't possibly waste any of it? No.
I think it really depends, right? Like in our investment portfolio, we do have a very small portion that we call a play. So we allocate a little bit of money. Having said that, we don't get into the really risky. Like when I say plays, really buying the non-dividend stocks, like like Amazon, the Tesla, and so on. So it's not like these very speculative stuff. I do know people that speculate, and we just look back a few years ago with the cannabis stuff. A lot of people speculate thinking that'll make them rich. Some people earn a few bucks out of that, but a lot of people didn't end up winning anything. Some people even lost a lot of money. I don't know. I'm leaning on your side, Nelson. Like any capital is precious. You shouldn't really speculate. And if you want to speculate, fine, but set amount a certain percentage or amount of money, right? So it could be like 1% your portfolio, or you set aside $500, whatever. And then you're okay if you lose it all, right? Don't go in thinking you're going to make $1 million out of $500. Go in with the idea that, hey, there's a really high chance you're going to lose everything. And if you're okay with that, go nuts. That's your investment style. That's totally fine. But it's kind of going to casino. You don't go in with the idea that, hey, you're going to become a millionaire. You're probably going in with some level of expectations. Okay, I'm going to lose so much, then I'm going to stop. Same idea, right? When it comes to speculative trading. I just want to kind of pivot a little bit, maybe not pivot, but go back to the whole AI bubble. I think the thing people are really worried about is that this AI bubble is going to burst, right? You look at all these tech companies like the NVIDIA, the Microsoft, Amazon, Google or Alphabet, even Tesla to a certain extent, they're all playing this AI technology thing. And as a result, their share prices have been going up and up, right? Sure, there's been some volatility, but generally speaking, it's been an exponentially growth. The worry right now is that is going to burst at some point. You look at the .com bubble, that's what happened to all these internet companies, or a lot of them. Remember, a lot of companies were not making any money, and they just like went IPO, and then all of a sudden they're like trading at crazy valuation, right? If I look at Cisco was a good example. I think at some point, you're looking at chart here, they were up at $75 in the height of the early 1999, 2000 timeframe. And then it went down to, I think, in the teens. So that was a pretty big drop. That was really the big worry investors have.
Yeah, I think I read recently that Cisco only something like last year, maybe this year even, was the first time that it surpassed that 1999 bubble, which is a long time to wait if you are a long-term investor. And of course, the thing with the .com bubble and what I can see repeating itself here in the AI bubble and in every other bubble that we've had in the last, say, 25 years is that it's always the trashiest companies that end up with the highest valuations. Because at the end of the day, these trashy companies just don't have any earnings. They're highly speculative. It's all just hype and promises for the future. And then inevitably management doesn't deliver. And that's when these stocks go down 99 to 100%. Like a lot of them end up going to zero. Where when you look at like a Cisco or something, there was a legitimate business behind that. It was just a very expensive, legitimate business that traded at a very high valuation. Amazon was the same way, legitimate business. So Bob, let me ask you, when you're looking at investing in something like that, if you've believed the hype, if you think it's legitimate and you want to put your money in and try not to miss this, what you think is the next big thing, how do you do so in order to protect yourself? How do you do that while also worrying about the downside a little bit?
Yeah, that's a very good question, Nelson. I think you have to go in with some level of expectation. Like I said earlier, you need to be okay with losing a certain amount of money, like a stop limit or stop loss would be a good idea. So say you go in with, let's say you go in with $5,000 and the stock is at $100. That's just hypothetically speaking here. And maybe you set your number at $50 a share. So if the stock ever goes down to $50 a share, you make up a rule saying you're out completely. So $50 is your limit. So that's that 50% loss. So that's fine. So set a rule before going in, at the most amount, you're going to lose a 50%. So you will lose $2,500. Now, if the stock keeps going up, a good thing to do is sometimes if it doubles, so it goes from $5,000 to $10,000, all of a sudden, a good rule of thumb is you sell half and just take your principal back. So you basically, whatever you earn, if the $5,000 profit keeps growing, that's an extra thing, but you already got your principal back. So that's something that you could do, right? And then if it keeps going up, you could just take another half. So always take some profit, realizing some profit instead of letting it keep going and going. All of a sudden it drops to not zero, but it drops down significantly. So that would be what I would do personally. Now it's hard. It's in theory it's easy to do, but psychology comes into play because people get greedy, and that I've seen that a lot of times, and I've done it personally as well. So you just need to make sure you're aware of that and really follow your rules that you set up for yourself.
Yeah, for me, it's hard for me to even talk about this in like less specific terms. I mean, at least in the last, I'm trying to think if I've ever invested like that. I've said before, I used to be like this deep value guy, and sometimes I would look at sort of these types of names when they had completely blown up, say a few years later. And one is Nortel. I did speculate on Nortel in, I think it was about 2004. I bought a little bit and I sold it a couple months later for a nice gain. No idea what I was doing. I was just trading it. So I say this because it's hard for me to even fathom thinking like this. It's just so unlike how I think. But it brings up the point where it's like, you can't go in it with the same type of rules as a long-term investor. I don't think you can afford to be patient with something like this at all. I think it's just you get in, you get your gain, and you get out, and then you move that money to safer places, because it's just this Allbirds chart that I've got pulled up here. It went from $17 to $10 in one day. I think it's even less than one day. Like, just the moves on these things just scare me so much that I couldn't possibly like even be patient. I would be in and out of this. Like, I'd be day trading it if I were doing it. And that's a terrible idea for all sorts of ideas. And two, it's where's your edge on Allbirds pivoting to AI? Like, I realize that sometimes, okay, if I invest in TD Bank, it's no, I don't have visibility into what that company's balance sheet really looks like. I understand that, but I think that management and the fact that it's a Canadian bank that's been around for 150 plus years, I think that those things factor into that decision where I can say, hey, I have some confidence in this. These guys know what they're doing. Something pivoting to AI, or what was it, like a couple of years ago where all the companies were pivoting to crypto and they were going to start mining Bitcoin, or they were going to put Bitcoin on their balance sheet or whatever it was. Yeah, those are just, I just can't trust management in those scenarios. And for me, it just comes down to gambling. And at that point, like you said, I might as well go to the casino. I'm going to have more fun at the casino. I can hang out with my friends and get pretty girls to blow on the dice when I play craps or something.
I think if you're going to invest in one of these high risk stocks, definitely don't put all your money into them. And this is where diversification becomes extremely important. Like, I wouldn't, if I was going to trade Allbirds, I maybe put 1% of my portfolio, and like you said, Nelson, maybe do like day trade, but that would take too much time. It would be so much pressure and stress. I personally, I wouldn't do it. But if you were to do these like AI speculative stuff, again, limit your loss, right? So don't go in with 100% or even over 50% of your portfolio, because you can either make a lot of money or you could lose a lot. So just limit your loss. But if I compare dot-com bubble and right now the AI, call it the AI bull market, there are some similarities, but it's also a lot of differences, right? I think the dot-com bubble at its peak, the P ratio reached about 80 times. Whereas right now with AI companies, the P ratio is somewhere between 35 to 40. So we're not anywhere close to that. And what the biggest thing I see is most of these AI companies are making profit. You look at NVIDIA, Microsoft, Google, Tesla, so on. They're all making profit and they're highly profitable. Whereas back in the days, in the 99, 2000 timeframe or even earlier, a lot of these .com companies weren't making any profit. They're just like imaginary, right? I don't know if you remember this one, Nelson. I'm used to watch a lot of Simpsons, but I remember there was one episode where I think Bart went to some internet company and they're like, oh, you get free shares and it's toilet paper rolls.
Yeah,
It's like, oh,
exactly.
ooh, I'm a millionaire. And then all of a sudden, oh, they don't worth anything. It's like that back in the .com bubble days, right? Whereas with AI right now, it's not quite there. And these companies back for the .com stuff, they're making money through IPOs and they all have very heavy debt. Whereas nowadays is more bigger companies, I would say. I think Ober's is an exception. So there's some differences. I think the biggest worry right now with AI is it's like the companies are all spending a lot of money. You look at NVIDIA, Microsoft, and so on. They're, hey, I'm Microsoft. I am going to invest $7 billion to NVIDIA. And NVIDIA is, oh, I'm the supplier to Microsoft. And I'm investing $7 billion back to Microsoft. And they're just like, it's very circular type of transaction. And are you actually making profit or not? And that's the biggest worry, I think.
That sounds like a Ponzi scheme to me. And I'm not accusing anybody of being dishonest or anything. Don't come at me with your lawyers. It's just that sounds an awful lot to me like a Ponzi scheme. But I think you make a really good point about the difference between the kind of legitimate companies that also have AI exposure and the just highly speculative AI companies. And because Microsoft is, I'm going to use Microsoft because I've been looking at the stock lately. I think it's attractive. It's a excellent business that just happens to have a money losing AI part stapled on, which is not the end of the world because it's like the AI part doesn't work out. It doesn't really matter because Microsoft still has Xbox. They still have Word. They still have Excel. They still have Windows. They've still got LinkedIn. They've still got all of these things that make money and that generate cash flow and generate dividends. And I've always said that one of the reasons why I like dividends so much is because it separates out the kind of the profitable companies from the unprofitable companies. Like at the end of the day, if you're not making any profit, you can't afford to pay a dividend. And so you look at Microsoft, it has I think the yield's about 1% now, which is admittedly not a huge dividend, but it is growing and it is a very real infusion of cash that goes out the door. And Google, Alphabet has a dividend. Meta even has a small dividend now. So you've got these actual legitimate companies that are pivoting into AI, but also have these hugely profitable, let's call them legacy businesses, even though I wouldn't really classify something like Facebook as a legacy business. But I want to ask you about what I think is the biggest bubble brewing in terms of just this AI bubble or kind of this current bubble, which is SpaceX. Bob, do you know anything about this SpaceX IPO that they're planning?
A little bit. I'm not actively following. It's like SpaceX, they make rockets and things, and they're tied to NASA a little bit. And looks like Musk is planning to do an IPO with SpaceX. I just haven't really looked into in terms of the revenue model. And so I personally don't know too much about it. Nelson, do you?
I will fill in some of the gaps for you because I was looking this up earlier and it is just absolutely bananas to me. Okay, like you said, Musk is looking to debut SpaceX on the S&P 500, or not the S&P 500, it's the index, onto the NASDAQ this year at some point. He is pushing for a $2 trillion valuation, which would be one of the 5 largest companies in the world. And SpaceX lost $5 billion in 2025. My understanding is it is expected to turn profitable in the next year or two. They have a lot of capex that they're spending. Basically, they're spending a lot of money on rockets, and that's expected to slow a little bit. But what do you think about buying something? Say we make $5 billion of profit in 2026. I don't know what the analysts say. It doesn't matter because the numbers are just so ludicrous. $2 trillion, which is 2,000 billion. And you're looking at $5 billion in profits. That puts us at
400 times.
Yeah, the math is failing me here. That is just, so what do you think about paying 400 times profits for
That's
SpaceX?
absolutely insane. I don't know why anybody would do that. Plus, it's not even profitable right now. That kind of reminds me of Beyond Meat, right? When Beyond Meat came out with their IPO, when I think it shot up to I think close to 200 maybe, or over 200. And I think last time I checked, it was less than $1. That's another example where there was like a lot of hype behind it, and then there wasn't much revenue behind this company, and then it was all hype. People think that the next best thing, and then all that money piling, and then a few years later, or pretty quickly, people realize the company is not profitable. It's actually burning a lot of capital through research and all that things, and the stock price reflected that. So I think SpaceX, if it's planning to come out with $1 trillion valuation, that's just absolutely insane. I don't see how you could do that. Yeah, that's just nuts.
Let's talk about, rather than just talk about how stupid these companies are valued, let's talk more about bubbles in general. Because I think if you look back over the last, say, 25 years, we'll start with the tech bubble, the dot-com bubble. Obviously, that was a huge one in 2000 that took a long time to recover. Then, of course, we had the financial crisis, which I don't think was really a bubble. I think it was just the bubble was there. Maybe it was in like the US housing market, but I think that was just everything went wrong at the same time. But after that, I think we had a kind of a commodities bubble in the early 2010s. Then in Canada, we had the marijuana bubble in kind of 2017, 2018. And now we've got the AI bubble. Oh, and I forgot the crypto bubble as well. So we've had, let's call it like, say, half a dozen bubbles since 1999, and they've all ended poorly. What are some ways besides valuation that we can look at bubbles and we can say, hey, that's a bubble, it's going to end badly? Is it like investor sentiment? Is that the big thing where everyone's rushing in and nobody cares about the fundamentals? Or is there more to it than that?
I think you need to be careful about following the herd and then all the hype, right? Like, it's easy to get stuck into that. And again, it comes down to diversification. It's fine if you want to play in the hype a little bit, but again, limit how much money you put in. And just because somebody tells you that they made 50, 100% in profit doesn't mean that's the truth. I think investors have a tendency to tell you about their profitable trades, but they don't tell you they're not so profitable trades or very unprofitable trades. So you have to be a little bit careful when you hear stuff, especially on the internet, because people are going to be trying to get you to buy things. And then buy my course, I'll teach you how to be rich. That has been around for decades. So yeah, I think you need to be a little bit careful. And I'm just thinking the NFT thing where pump and dump, that was the strategy, right? You pump something up and then you get somebody to buy it from you and then you dump it. That's another scary thing. So you need to be a little bit careful with that. I just want to go back to AI a little bit, Nelson. I know Anthropic, which is the company behind Claude, I think they're looking to do IPO as well. That one could be interesting in terms of IPO. I don't know. They use Claude at work and they charge these enterprises money. And when you use it, you use up tokens and then you spend money. But the company is also investing a lot of money in AI data centers. So I don't know, like in terms of their profitability or their gross margin. So that's something that would be interesting when they do come out with IPO. With going back to AI, I think AI is definitely here to stay. You see a lot of companies utilizing AI now. I do that at work and it's saving me a lot of times. And then AI is getting more and more capable, which is kind of scary. Like you can use AI to generate PowerPoint presentation or even write a document and so on, right? So it's interesting. So there's definitely usage cases behind AI and companies could charge money from it. Whether these like Anthropic and other AI companies actually make money or not, that's more of a question you need to do a little bit of study. But yeah, I think we've seen bubbles come and go. Like the crypto, it's bubble, but it's like it dropped. It's so volatile. I don't know if it's completely a bubble per se. Cannabis, yeah, that was super speculative a few years ago. So again, I think you just need to be careful and watch what you buy. And I think ultimately the fundamentals and valuation matter, especially when it comes to these kind of speculative trades.
I took a look at Anthropic, whatever. This shows how little I care about AI, which I'll go into a little bit of a rant here in a minute. But the valuation they're looking at for the IPO would be somewhere in the neighborhood of 600 billion. And no, they are not profitable. Nobody really knows how much money they're losing, but the speculation is that they are not profitable at all. Who knows how long it'll be until they are profitable. But I will go on record as saying that Canadian dividend investing is a 100% AI-free publication. I do not use AI. I will never use AI in it. I think that AI is the antithesis of creating content. And I hate it when I call it content. I don't want to call it that because I would prefer that I tell stories. I tell financial stories. And this is my old man yelling at a cloud here thing, because I just dislike, I have a buddy who he tells me, hey, look at the picture I made with AI. And you didn't make shit, man. You type something in a computer and it made it for you. You're not creating anything. And I understand the usage of, hey, I need to get some work done that I don't want to get done. AI, do it for me. By all means, go ahead and do that. I understand. I get it. Nobody likes to do the grunt work of being in an office. Nobody likes to do grunt work, period. I get it. I just really struggle with a world where we are outsourcing writing, we are outsourcing creating art, we are outsourcing the very things that make us human to computers. I think that robots should clean toilets. They should not be writing stuff for people to read and enjoy. Sorry, rant over. You can get back on topic now, Bob.
Yeah, no, I 100% agree with you, right? The creative side, yeah, sure, these AIs can mimic things, but you need that human aspect, and that's where we do best. If you use AI to help you do a little bit of research or do these groundworks, yeah, I think that's totally fine. If it make you a little bit more efficient, I'm okay with that. But yeah, I see people are making videos with AI, and you sometimes see these YouTube videos that's just completely AI made. I don't watch those because I just find them not as interesting. So yeah, anyways, going back to the main topic here, are you worried that this AI bubble will happen eventually and it'll burst and it'll affect across the entire market? Or you think it's just going to be specific companies that are AI focused?
I think what's going to happen is very similar to what happened after the last tech bubble, the 1999-2000 bubble, where we laid a lot of fiber around the world for the anticipation of all this internet traffic that was going to come and going to change everything. And then the bubble burst, but that infrastructure was still there, and we slowly grew into it and we slowly used it. And I think that the AI bubble is going to end the same way, where for a lot of these highly speculative AI companies, it's going to end in tears, but the infrastructure will be in place in order for the next generation of AI technology to be there. So do I think AI is a flash in the pan? It's going away? No, I think it's here to stay. But I think that the bubble aspect of it, everyone is so excited and that it's going to replace our entire lives, it's going to do our taxes for us and tell us how to do everything. That's going to not be as much as what we think it is today. It's going to slowly pan into something, just not it's not going to revolutionize things, at least not yet. We'll slowly work our way into it. Yeah, I don't know. How about you, Bob? Any thoughts, any additions to that?
No, I think I agree with you, Nelson, on that front. When you look at the internet, the tech bubble, I would say a lot of these companies that didn't have any revenue, they were way ahead of their time. There were a lot of companies that were thinking streaming type of services, etc. That's what we have today with Netflix and Spotify and stuff. But back then, web apps fiber was too expensive for everybody. But the speed just wasn't there to do streaming. So it was like the technology was way ahead of its time compared to the use cases. This is similarly to if you look at the telecom a little bit. Your phone, my phone, are probably mostly likely on 5G. 5G was like the next big thing where it's going to bring a lot of different leading edge things. But for the most part, we haven't seen that or haven't really seen it. They were talking about robotics through cellular networks and things like that. For the most part, that hasn't happened. Or cars driving themselves, talking to each other through cellular networks. That hasn't really happened. But the capabilities there, especially now with AI, you could have two cars talking to each other and then utilizing AI to optimize the model. So I think it's going to go there eventually, but I think the technology aspect is much ahead of the application. That's quite typical if you look at any technology trend. So yeah, I think it's going to take some catch up and somebody or people are going to figure out how to use the AI capacity for the different application. Or it's also like robotics, like hardware, and then integrating to AI, like how do you utilize that? We're not quite there yet. So a lot of these companies are making the capacity, but the application isn't quite there yet. So it's going to take time.
I was at Costco the other day. I posted this on Twitter. There's a washer and dryer set for, I can't remember how much it is, so I won't say. It was a reasonable price, though, because it's Costco, and of course, everything's a reasonable price. And on the description, it said, enhanced with AI. And I said, who wants that? Who needs a washer and dryer that are enhanced by AI? To me, that sounds like just something else to go wrong with it. But I want to pivot maybe a little bit here because I wanted to tell you guys the story about one of my newsletter readers. And this was back in, I'm going to say 2023. He reached out and he showed me his $1 million TFSA. And of course, as these are very rare in Canada, and he had one almost 3 years ago now. And what he did was in 2016, he put his entire TFSA, which was at the time was worth about $70,000, and he threw it all into the most speculative marijuana stocks he could find. There's about 4 of them that he put them into. I don't even remember which ones because I stopped following the sector years ago. And he turned it into about 700,000. And then from there, he put it into boring kind of dividend payers, which were up 50% between then and there. So he was at like kind of 1.1 million in his TFSA. So it is a story that if you get incredibly lucky and you find a bubble as it is happening, as it's starting, you can do incredibly well at it. And to his credit, he was smart enough to realize that, man, I better not squander this. I'm going to turn it into a much more conservative play. If he's listening, please email me again and let me know if your portfolio is still doing fine. But I just wanted to maybe throw a little bit of good news into our poo-pooing of bubbles.
Kudos for this reader of yours, but just playing devil's advocate here. How many people got caught on the flip side, right? So
for sure.
That's the other thing is, you hear these these stories that people walked out of these bubbles or speculated plays and made a lot of money, but there are also a lot of people that lost a lot of money. There's that movie about the GameStop.
Yes. I love that one. Yeah.
And a lot of those people in the movie, and those are based on real people, they were holding on and they end up losing money, right? Just because somebody made money doesn't mean everybody made money. Yeah, it's tough, right? So again, that's where you need to be diversified and really understand your risk, because you could very well, for this particular reader of yours, he or she could very well lost all that money in the TFSA. It's a coin flop, right?
It's worse than a coin flip. It's just one guy got incredibly lucky and the other 99 who did not. Like, obviously, they're not going to email me and tell me, hey, Nelson, I lost 50% of my TFSA speculating on marijuana stocks. Nobody's going to do that. You shove that knowledge deep into the furthest part of your brain, and hopefully you never think of it again, or hopefully you learn a lesson from it. But of course, a lot of people don't, because I think that ultimately, when it comes to bubbles, it is this desire to get rich quickly. And of course, we all have this desire to get rich quickly. I play the lottery, not religiously, just when it gets up to over 50 million, because I like to tell my friend that I can only afford to retire if I have 50 million or more, which always pisses her off, which is great fun. So I understand. I understand why people want this lottery ticket mentality. Nobody wants to get rich slowly. And that's bubbles. Bubbles are if you put your money in Fortis or you put your money in some other similarly boring stock, that is not going to happen. You are going to compound at 9 to 10% a year. And, it's going to feel like everyone is passing you, because you're going to go on social media and you're going to see how everybody sucks compared to you. So I think that's why bubbles exist. I think that it is a universal human desire to get rich without doing the actual work, because Bob, you and I have both slowly grown wealth over time. It is hard work. Nobody wants to do it. And unfortunately, these companies, these assets, these hot sectors tap into that part of our lizard brains that wants the results without doing the work, and it exploits it. And whether that's on purpose or not is perhaps maybe a cynical way of looking at it, but that's what happens. And that's the unfortunate part about it.
Yeah, I think you could either get rich quickly or get rich slowly. I would more lean on the get rich slowly, slow and steady. Almost always wins the race. Obviously, you're going to hear about people getting rich from these AI stocks, or going back a few years, a lot of these Tesla employees were all millionaires because they have a lot of Tesla stocks. And then you look at NVIDIA, a lot of NVIDIA employees are millionaires or more. Same thing, right? They got lucky and the company happened to do well. But is that a recipe for success 100% of the time? Not necessarily. I know people that went into certain companies thinking the company will go IPO and so on. Now, some companies do go IPO and they made a lot of money. I do know people that after 4 or 5 years doing the same grind, and the company just didn't go IPO and all their equities basically went poof, right? So you hear success stories, but you don't hear too much about these people that lost money. So just be a little bit careful when it comes to things like that.
Let me ask you, Bob, one last question here. I know we're pretty close to time here. Do you think that social media has made this whole fuss that we all go on Twitter, we go on wherever, we see that these stocks are going up, that it seems like everybody is getting rich quicker than what we are, and therefore we change our actions, we change the way we invest? Do you think that social media has made all this worse, or do you think that humans have always been this way, and before it just happened quietly in closets, in dark rooms, whatever? What do you think?
I think humans have always been like this, but the spread of information is definitely quicker with social media. So you could find these speculative stocks or companies way quicker, and people pile on quicker. So it escalate and become a bubble potentially quicker. Right. Yeah, I think you could get a lot of these call it nonsense information on social media. You really need to screen through the info to make sure you get blinded by them. Yeah, it's tough. It's definitely tough, right? Because you hear stories all the time about this so and so made millions because this person invested in certain companies, right? And you're like, oh, why didn't I do the same thing? Or maybe you hear about it and you jump in and invest in that company later, but it's already at the top and it's free falling, right? So I think it definitely has made it worse with social media.
That's it. Nobody puts their losses on social media. Nobody. Like, I shouldn't say it. Every now and again on the Wall Street Bets subreddit, you get somebody who talks about all this money that they've lost or whatever, but for 99.9% of people that blow up, just very quietly blow up. And that is always going to be a problem with social media. All are the people who succeed or the people who say they succeed, and you never see that more sobering look. But Bob, I think we are right about out of time here. Have you decided, so how much of your net worth are you going to put into the AI bubble? Is it 99% or is it 100%?
We do own a little bit of, I mentioned Amazon. We have a tiny bit of NVIDIA, but yeah, it's less than 5%, probably less, even 2 or 3% of our overall investment portfolio. And I don't plan to hold on to those for too long. Although Amazon, we have held it for quite long now. But yeah, I think it's about knowing your exposure and limit your loss, right? Don't back up the truck on these highly speculative stocks. It's just too dangerous.
Yeah, for sure. And Amazon, I don't think Amazon's an AI bubble stock. I think Amazon has a whole bunch of good, legitimate businesses behind it. And then just this kind of highly speculative AI division, which those, so it's, I'm joking with you about this, obviously, but it's for people listening. I don't think Amazon or Microsoft or any of these guys are speculative AI stocks. But to answer my question, I think that I'm going to not only put 100% of my portfolio into the riskiest AI stocks, Allbirds, for instance. I'm going to borrow as much as possible and then go ahead and do that. No, obviously I'm not. Please don't take that quote out of context. Okay, we're going to wrap it up here. Bob, thanks as always for joining me. Thanks everyone for listening. Please make sure you subscribe either on Spotify, YouTube, wherever else you might get podcasts, so you can hear our sexy voices and my ranting at clouds. All right. Thanks, everyone.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.